Hi, everyone, and welcome back to our 4C Markets podcast. My name is Alejandro Ramirez Limas, and I have my co host with me, Sarhi. Sarhi, if you want to introduce yourself a bit.
Yes, hello everybody. My name is Sergey, and today Alejandro will share with us very interesting topic. What can we do with treasuries, right?
That's correct. Okay, so for the purpose of this presentation, we allowed the automation system that we used to run and created a portfolio today, which, as always said, outperforms the S&P 500. But what happens if everything is failing, and even though you're doing better than the S&P 500, which is a measurement of the overall market, you're still losing money, right? Well, there are other assets that you can get into. So first of all, I'm going to go and show the total gains for today. As we see, there were a few stocks that performed better than the S&P, and as a whole, the market performed worse than the portfolio we chose, right? According to what we picked for today when the market opens, we only lost 0.38%, while the S&P 500 lost 1.47%, but we still lost money. So that doesn't mean that there's nothing for you to put your money on, right? You still want to diversify your exposure. Like in this case, we diversified over many different spaces. And we also want to do asset allocation where we have equities and stocks. But even with all of this preparation, you could still be at risk. So today we're going to talk about government bonds and how they work. So I'm going to stop sharing my screen, and then Serhi, if you can share yours, please.
Yes, sure. Can you see my screen?
It's coming together. We just see a blank screen. There it is. So this is our Charles Schwab account, and we're gonna try to hide a lot of the information we see here because we don't want to put too many things at risk. This is a real account. But basically, to get to government bonds in Charles Schwab, you go to trade. So, sir, if you can select trade.
Yes.
Yep. And then from here, you would select bonds, and that will bring you to the screen that we're looking at. So when you are within the search criteria of the bonds that you're doing, you're going to end up with this particular screen here that's going to tell you what you may want to invest in. Now, I personally like U.S. Treasuries, but there's a whole array of things that we can do. So, Serhi, if you can go to the 3-month U.S. Treasuries that are currently giving a 3.72 yield, please. Top left. Yep. It's the top left. Yeah, that's the one.
Yep. This one, right?
That's right. Yeah. Okay. So now from here, currently the search criteria says that we're going to be looking at June to July. But what if we are not interested in June to July? What if we want something different? You can always modify your search. So go ahead and press modify search. And we're going to do March and April. So go ahead and do March. Yep. And then April here. So this gives you just 1 month. So now when we do, or do March to May, so we actually get the full month of March, the full month of April, and then partially the month of May. There we go. Okay, so now go ahead and press search results. And now what this will do is it will show you all of the bonds that are available that you can purchase. And if you look at the search criteria on your screen, if you can scroll up a bit, yeah, the search criteria right here shows you what you're looking at, plus the yield to maturity, which is how this is sorted by.
So basically, we
So
can get like shorter periods and faster return for our money, right?
correct. So you can get shorter periods, faster return for your money. If you want to hold it until maturity, you can just select the stock that's going to hold to maturity. So I'm gonna just tell you a few things about this, and then we're gonna go into an Excel sheet that we created that gives us the best way to calculate this. So if we start here, the one that says action, this is the button you would press to buy one of these. And when you buy this, you're buying it at a discount. When it matures, you get the full maturity price for this. Coupon is whether this has a coupon that goes with it. If it has a coupon, you're gonna get it either quarterly or on maturity. So that's column number 2 where it says coupon. So yep, there we go. That's the one. So some of these have a 0.75 coupon for every $100 you get 75 cents a year. So like the one with 2.25 would give you $2 and $2.25 for the year after the maturity period, right? So this means that you would buy this at a discount and you would get a coupon on top of your expenses. So the price that you pay for this is the discounted price that you are going to pay now to get $100 at expiration. So if we look at price, Serhi, if you can highlight the column price. Yep.
Yes.
So here this is saying that if you buy a bond for $100, it's going to cost you $99.92. And at maturity, you're going to get back $100 for every one of this that you buy. All the other columns are just metadata. So, for example, in this one that Sergey was highlighting, it says that the minimum is 50. That means that you have to buy $50,000 of this. That is the minimum that you can buy, right? This is measured in thousands. If you're super wealthy, then the maximum that you can buy is 66,710 multiplied by 1,000. So 66,710,000 of this. And the yield to maturity on this would be 4.068. So how do you actually calculate how much you get? So Sergey, if you can bring up the Excel sheet that we created earlier. Yep, this is the one. Okay. So we took this information that we were getting on Charles Schwab and we put it on this Excel document in order for us to get a better understanding. So here we're going to be looking at the very top line. This basically says that if you buy 100 if you buy $100, your net gain on this is going to be shown on column R and it's going to be $2.94. And the reason why this is red is because there are better purchases that you can do. So now if you go all the way to the next column after R on the right.
Yes.
Yep, right here. So this is your total gain for $1 million over a 6-day period. So if you look at column N on this is telling us that this will mature in 6 days. And in 6 days, when it matures, you're going to get 0.02945 cents for every $100, or basically 3 cents. And if you put $1 million in it, you're going to get $300 back in 6 days for your $1 million. So it doesn't look very attractive, but when you compare that to the fact that the S&P 500 just lost you $3,000 for the same $1 million, getting money back is actually a nice return by comparison, right? Because if you look at the absolute values, that means that instead of losing over $3,000, you're making $300. So you are on the positive instead of the negative. But let's say that you actually want to hold this for a month because you are looking at keeping your money safe. So, Sergey, if we can scroll down to the very last row. So you
Yeah,
see what
basically
happened?
it's only like 6 days. Yes. And now it's like
Right.
9 days to have like one flip. Positive is the same number, but positive. Yeah.
Exactly. So if you have a portfolio that you are trying to keep your money safe now and you're thinking, okay, I don't want to be in the stock market because it's just too much for me. I want to put this on a completely safe place. You can put it on government bonds. So this is saying that if you have $1 million and you buy government bonds, after 1 month, instead of risking your money and losing, you would end up with $3,420. How does this translate over a 1 year period? Well, if you multiply this by 12, you would end up with approximately $40,000, I think, right? If you multiply this by 12, yeah, $41,000. So if you have $1 million and you don't know what to do with it, you can buy yourself a government bond, make $41,000 at the end of the year, and be completely stress free. So how does this compare to what we have been discussing? So if I want to share my screen now, and if we're looking at this here, as you can see here, in the same time period, now for 1 day, we just lost $3,000 over a $1 million investment. A government bond says that over 6 days, you would make $300 over that same investment. And then if you keep it longer, you would make even more money on this, right? You don't have to hold government bonds until maturity, but it is very smart to hold them as long as you think there's going to be volatility in the market. So the takeaway from this is that there is a lot of places where you can save your money. You can either save it in the stock market, which has a lot of risk. And when we're facing situations like what's happening now, where everything is dropping, even if you have a very, very smart portfolio, that outperforms the stock market, you could still end up losing money. So putting your money in government bonds is a very smart investment. And it doesn't really matter where you're from. If you open a Charles Schwab account, you are able to buy a government bond for the United States. You don't have to be from the US. But you can do the same thing in the Japanese market or the UK market. Um, all the markets that I'm aware of from the government, they are able to sell you government bonds because this is how the government loans uh, money from people, right? This is how they borrow money from people in order to complete projects. Like, let's say that they want to build a new road, they're going to push out government bonds, and those government bonds will allow them to get extra money besides the taxes that they're charging in order to build this construction. And so that's what this system is for. What do you think, sir?
Yes, this is like really amazing because when you look at this like alternative ways of funding, I really love this way how you explain things. Because for me, it was, just when I was learning this kind of things in the university. So basically, it was just, like a series that tells you, okay, this money moves from here to here. But when you're like starts to speak in like where they actually are spent by the government, it's like really brilliant. I think it gives like perspective of how everything, like how economics work, how governments work. And yeah, it's really cool. And at the same time, uh, we learned a new instrument today, how to use during these times and how to make our money safe.
Exactly.
Yeah, thank you.
So now we leave you with this. If you want to keep your money safe, there is no safer place than government bonds because they are going to give you what is called the risk-free rate. And what we just saw was that if you have $1 million, you can either risk it in the stock market, and what is happening now is going to continue to create volatility, or you can put it in a government bond, keep it safe, and go about your daily business until you feel like you're ready to re-enter the market. Or you can do a combination of all of this together. And with that said, we will leave you. Thank you for watching our episode from Forcey Markets. We wish you a very, very great day.
Yes, subscribe and see you later in the next episodes.
On the next episodes.